How are you going to use your mortgage in the future? What is your vision of your debt? I like to think of myself as a debt manager most of the time, because the idea is not to put you into more debt or to put you in a home that you can't afford, or for you to refinance your student loan debts or your credit card debts into your home so that you can have more debt. The idea is to have more hard, fast cash, or better cash flow, to be able to put that cash onto other debts or use that cash flow into more investments to accrue more income or free up your time and whatever's important to you. I am Brandy Whitmire. I'm a direct lender, broker, banker. I am nationwide. We have just about every product under the sun, but if I don't have it, I can direct you to the place who does. And we work with the best real estate professionals all across the country. So if you have any questions about homes, financing, anything under the sun, always reach out, and I am happy to be here and offer any assistance that I can whatsoever. So today, I want to talk about leveraging your time with your mortgage. And this is a very important subject for me, just in general anyway, because time is our most valuable asset. We are constantly thinking and working about how we can get time to work for us. How can I get this work done faster? How can I trick myself into doing the things on my to-do list? How can I get to work faster? How can I get cheaper gas? Getting cheaper gas is the same thing as getting a lower payment, because you are trying to find out how to get more money. Because if you have more money in your pocket, are you leveraging time? Absolutely, because if that weren't the case, then you wouldn't be trying to increase your hourly wage or your salary or gain more sales or anything like that under the sun, right? So we're always looking that, because you're trying to leverage time. If you're wanting to make more money, you're leveraging your time, because you're trying to fit more money into that block of space when you are, so that you don't have to trade time for work, right? That's essentially what we're doing. Or we want more things. You want that purse, you want the bigger house, you want the other car, you want to pay off debt, whatever the case may be. You're leveraging time. Essentially, that's what it is, okay? So, interesting story today. I got an article in my inbox, and it talked about today, November 14th in 1883, the telegraph kind of like changed our world, right? So telegraph had already been around about 3 decades before that. About 30 years before that, we had the telegraph. And basically, it was awesome because when the telegraph came out, we could send an instant message to someone that was about 100 miles away. And whenever they start building out more relays and more relays, by 30 years later, in 1883, they finally got it to where we could send a message instantly 1,000 miles away, which is huge. Kind of hard to think about now whenever we can send anything in the entire world in a split second. So what happened was, when that happened on this day, November 14th in 1883, is they sent a message 1,000 miles away, and it was to our military, right? And they needed something by a certain amount of time. And back then, we used our time as the sun, like our noon. Or let's say if the sun came up at noon, that was our noon. If the sun came up at noon, when the sun came up in New York, that was noon. I'm just using that as an example, okay? So our time was different from that time because, of course, we're on a different axis and things things change. So what happened is they had to create, because, if you say I need this by 5 o'clock, 5 o'clock in New York is going to be different from 5 o'clock in Dallas. So what happened was they had to set a standard for our military, and as the communication went faster, to build out our 4 time zones in the United States. Well, that worked so well that it made it a global standard within 1 year. And you think about how long it takes the government to do anything right now, and to make something a global standard in 1 year just shows you how much our idea of time changed even then. And that's what we are doing here. So I just thought that was interesting, how technology, how they were able to leverage time through that technology and make it work, where now we have to use this system and use a global system, a time zone system, in order to manage our time correctly, because we still only have 24 hours in a day, no matter what. So my idea is that you know, what I try to talk about when I'm looking at first-time home buyers or people are going to refinance or anything like that is, how are you going to use your mortgage in the future? What is your vision of your debt? I like to think of myself as a debt manager most of the time, because the idea is not to put you into more debt or to put you in a home that you can't afford, or for you to refinance your student loan debts or your credit card debts into your home so that you can have more debt. The idea is to have more hard, fast cash, or better cash flow, to be able to put that cash onto other debts or use that cash flow into more investments to accrue more income, or free up your time and, you know, whatever's important to you, paying off debt, being able to go on vacation, being able to, giving you more freedom in some way or another, or relieving you in some way or another. So mortgage is a vehicle to that vision. Your mortgage is a vehicle to all of those things, because you can manage time through this vision. Now, think about renting. When you're a renter, there's no leverage there. You're paying an X amount per month. You signed an X amount of months on your lease, and when you leave, you're hoping that you get some kind of deposit back so that you put it back into the new place to do it all over again. You're never building any equity, and you surely can't do any of the things I'm about to talk about in order to take money and put it somewhere else. Okay? Many avenues where you can leverage your mortgage in time. Number one is your most obvious, and that's going to be through appreciation. The national average of appreciation is 6%. So it's actually 5.4% per year to be technical, but that changes as the house sizing gets bigger. Anyway, but the appreciation is about 6% per year on a national average. So as time goes on, as you're in your home, the more your house value is going to go up. Now, that's mainly going to be due to your land value, because land is a finite resource, right? Land is considered an unlimited, to have unlimited useful life. It's not going anywhere. It has unlimited useful life, and it's a finite resource. So when appreciation happens, it's typically due to the land. From the ground up is called the improvement, and that's what's going to have your depreciating value. So that's why it's very important to keep your house up, use a renovation loan to do the updates, make sure that your house is in line for your community, and you're not bringing other values down, and keep your appreciation going up. The second obvious way that you're leveraging time is, as you pay your mortgage, every single month, a portion of that payment is going towards your hard balance. It could be a little bit or a lot depending on your term, 30, 20, 15, 10 year, whatever the case may be. But unless you're in an interest-only loan or a negative amortization loan, like a reverse mortgage, you are paying down every single month. So you are also leveraging that time. So in a year, you should have 6% appreciation. This is an example. And you've paid down the mortgage, let's say $2,000 to $3,000, just as an example. So now you're opening that gap and you're gaining more equity, right? So same thing with making an overpayment. Your payment's $1,000 a month, but you put in $1,100. You're using that $100 a month to leverage time, because your interest is only going to be based off of your actual balance. That's why it's important to not increase your balance with a lot of closing costs and a lot of things like that, unless you're going to keep the loan for a long amount of time. The idea is to keep that balance going down so that the amount of interest you're paying on that balance, more of your payment will go towards principal instead of towards the interest. So every single month, when you make a payment, even right now, whether you're making overpayment or not, every single month, a little bit more of that payment is going towards that balance, just a little bit more. Even if it's just a few dollars a month, a little bit more is going towards that payment. And the reason why, towards your balance, and the reason why is because you owe less. So the less that you owe, the better it's going to be. So if you're making overpayment, and let's say you're refinancing, you're paying off high interest debt, and let's say you're adding $20,000 to your loan, but let's say you saved $500 a month in monthly payments, and you have a new payment that's around the same that you had before. Now you have $500 free of cash flow, and cash flow that you can go pop onto that payment. Or you can switch from a 30-year now to a 20-year and level out your payments, and now your interest paid over the life of that loan is going to be significantly less. I've seen it in the $200,000, $300,000 range of less interest payments, even more than that really. But I mean, it is significant. So you want to use a calculator. If you want a calculator, please ask me for one. I can show you what doing an overpayment can do every month. Even if you don't own a home yet, it's really fun math. And I know that I just love math, but it's really fun math to think about and look at your own situation, or what, even if you don't own a home yet, what if I did own a home and I had this, what could I do? How could I leverage that, right? So we always, we already talked about shortening your term, and decreasing your monthly payment. You are leveraging time. If you shorten your term, if you go from a 30 to a 20, then you are moving that money around and you're saving money. Okay, and also when you refinance, let's say you were refinancing and I was closing you on December 5th, and you hadn't made that mortgage payment yet, and your mortgage payment was $1,000. So if you hadn't made that mortgage payment yet, you would have that $1,000. You're not going to pay in payment in January. That'd be another $1,000. Your first payment would be February 1st. So you'd have $2,000 hard cash. Now there's interest and there's things that add it to the loan, but you'd have $2,000 hard cash. Would that $2,000 or whatever those two payments, would that be better served on paying off a high interest debt? Would that $2,000 be better served making a one lump sum payment onto your mortgage, so that your total monthly payment, that a portion of that, more of a portion of that, is going towards your balance? Yes. I mean, absolutely. Not only that, if you're getting an escrow check back in the mail, your escrow check back could be anywhere from zero technically to, we just had a guy that's getting an $18,000 escrow check back. He has a $550,000 house here in Irving, but he has $18,000 coming to him as a check. Do you think it would be smart to take that $18,000 check and pay it on anything that's over the 4.5% that we got him, or on any of those other debts, or take that $18,000 check and slap it down onto the balance of that mortgage so that more of his monthly payment is going towards his balance? Of course, yes. Do you think that's valuable? Absolutely. And especially when his payment is going down, he paid off debt. He's putting himself in a much better financial situation, and that's called leveraging the time, because those payments, you refinance, those payments are backed up in arrears, and you have that money in hand. That's leveraging time. When I'm able to save someone, 2 payments, and those payments are $4,000 a month, and they make $6,000 a month, that's 3 weeks worth of work for them. That's leveraging time. I just got you three weeks worth of work, or a month's worth of work into your hand for you to go pay down something and not have more and more interest accrue over time. That's huge. So another way is removing mortgage insurance. So I have a lot of people who say, hey, Brandy, you put me in this FHA loan, or you put me in this that always has mortgage insurance, or you put me in this conventional loan at 95% and I have mortgage insurance. I don't have enough appreciation yet. I don't have enough equity yet. I haven't paid it down enough yet. So if you have a monthly payment of mortgage insurance, that's not true. That even if you have a low interest rate, it's not necessarily true that you need to wait until you have 20% equity, because even with the rates being a little bit higher right now than with what you have, because there are so many different mortgage insurance programs now. So we're being tested with Fannie Mae right now for what's called enterprise mortgage insurance, where it's built into the rate. So instead of having a monthly payment of $100 to sometimes $300 for mortgage insurance because you don't have that 20% equity, it's built into the rate. So let's call it $100. So let's say your principal and interest part of your payment goes up $20 with a new loan, but you remove that $100 payment and you're saving $80 a month. Don't you think that's valuable? Yes. And then you're talking about you have more interest payment to write off at the end of the year. And I'm not a CPA. Consult your CPA on anything tax related, but that's what I do personally. So personally, every year I'm going to if there's a benefit, I'm going to refinance every single one of my properties so that I can take those payments, put it onto my balance, take my escrow checks I get back in the mail, put it onto my balance, or put it onto high interest debt, or take my family on vacation, or take myself on vacation, or whatever the case may be, or just put some money in the bank and have myself a little nest egg. It doesn't matter what the money is for. The idea is how to get hard cash in your hand to be able to pay down hard debt, or use that to further benefit you in an investment or whatever the case that you may need. So a mortgage or multiple mortgages is a clear way to get ahead. Ownership and financing puts you at an advantage that renting cannot. You cannot leverage renting. You can't. Are there benefits to renting? Yes, but leveraging time and money? No. Okay. So, is moving good debt or bad debt to good debt good? A good idea? Bad debt being credit cards, student loans, things like that, to a good debt, which would be a mortgage. Is it a good idea? Moving it to be able to the smartest place to be able to leverage time and money and to lower your interest and increase your cash flow will always be the smartest way to go. It will always be the smartest way to go, pretty much. Now, I'm sure there's some kind of example somebody can give me somewhere that's going to tell me, well, in this situation, of course there's one-offs. That's why I need to look at it. That's why I need to look at your specific situation and say, okay, here's what I see. I see this opportunity for you, and if you did this exactly this way, you would be able to save yourself this amount of money. And of course, you have to be disciplined. If I'm saving you $500 a month on bad debt, and you're not taking that $500 and throwing it onto your principal or throwing it onto another investment or other high interest debt, then that's on you. But I'm going to show you the vehicle. I'm going to show you the way. I'm going to give you a plan in order to make that happen for you. So, I want to close with the advice I like to give a lot of my clients, and I did this whenever I was a realtor as well, is taking the emotion out of your home. I know that it's difficult whenever, let's say it's your first home and it's your first sign of independence, or it's where you got married, or it's where you had your children, or it's where you fell in love, or where you once loved someone, or even where there was strife and challenge and binding moments, divorce situations, which, people don't want to sell because this or that, or he's not going to get it, she's not going to get it, or I can't, I don't want to remove myself. Emotion doesn't tie to logic. And I think we all know that if you've ever been in love before, if you ever have made decisions based off of emotion, we know that emotion doesn't tie into logic very well. So when it comes to finance and it comes to putting yourself in a financial situation that's going to be better for you, it's very important to take the emotion out of it, because finance is math and logic is math, and we know that. So if it mathematically makes sense and the plan makes sense, and at the end you come up ahead financially or put yourself in a better situation to ease your mind, to increase your net worth, to increase your cash flow, or where you don't have to put in those extra hours or have that second job or worry or not have money to put into retirement or put your kids through school or whatever. There's so many ways that a mortgage can help you leverage that time and help you in future or now financial situations. So keep in mind, there always has to be a net tangible benefit. There always has to be a benefit to your refinance. So whenever you're going to your lender, and hopefully that's me, and hopefully I'm delivering you content enough where you trust me, where I will show you the way, whether you work with me or not, I would want to show you that way and give you those options so that at least you're out there putting yourself in a better situation. But remember, there's always has to be a net tangible benefit with any lender. We're not allowed to just put you in this loan or that loan if it's going to be bad for you. We're not going to be able to help you pay off debt or shorten your term or increase your term or lower your rate or remove you from FHA to conventional, whatever the case may be. We're not going to be able to do it unless there's a benefit to you. We're not going to, it's illegal. And that's what underwriting is for, to make sure that there's not predatory people out there going after you like there once was before, which caused a portion of the economic crash. So keep that in mind. I hope this was beneficial for you. I am open to more ideas and topics for any of the weeks to come. And if you have any questions at all, of course, and as always, please reach out, DM, email me, bwhitmire@financemyhome.com, brandywhitmire.com. You can find my info. Always reach out to me here on DM or on the comments or anything like that. And I will see you next Wednesday at 6 p.m. Talk to you soon.